The letter arrived in March, about 13 months after her husband died. Carol was 74 years old. She had been married for 47 years. She had never handled the taxes alone, not once in their entire marriage. That had always been Franklin's job. He had used the same tax software every year, printed the returns, signed them together at the kitchen table, and mailed them before the deadline. It was a routine, the way most things in a long marriage become routines. Franklin passed away the previous February. Carol filed that year's taxes as she always had, married filing jointly, because their accountant told her she was still allowed to do that for the year her husband died. The return looked similar to all the ones before it. Nothing alarming. Then came the second year. When Carol sat down with her accountant to prepare her first return as a single filer, something had quietly changed. Her income had not changed dramatically. She was still receiving Social Security. She still had the same IRA distributions she had always taken. Franklin's pension had transitioned to a survivor benefit that was somewhat smaller, but she was still bringing in nearly what the household had always brought in. What had changed was the tax code's treatment of her. Where the couple had once filed with a standard deduction near $35,000, Carol now had a deduction just over $18,000. Where their joint income had comfortably fit inside the 12% tax bracket, Carol's same dollars were now being pushed into the 22% bracket, because single filer brackets are roughly half as wide as the brackets for married couples. Her tax bill for that second year was several $1,000s higher than the year before. Her income had actually gone down slightly, but her taxes had gone up. Her accountant had a name for it. He called it the widow's penalty, and he told Carol, gently, that it had been possible to reduce it significantly, if she and Franklin had known about it and planned for it while he was still alive. She had not known. Franklin had not known, and the window to plan for it had closed the moment he passed. In this video, we are going to follow Carol's story from beginning to end. We are going to show you exactly how the widow's penalty works, what triggers it, how it compounds over time, and, most importantly, what married retirees can do right now while both spouses are still alive to reduce the damage before it happens. If you are married and retired, this video is for you. And if you are already a surviving spouse, there are still steps you can take, and we will cover those too. What happened to Carol is not unusual. It is, in fact, one of the most consistently overlooked financial transitions in retirement. Overlooked not because people are careless, but because it happens at the worst possible time, in the months and years when grief is already consuming most of a person's energy. The widow's penalty is the name financial professionals give to a specific set of tax and benefit consequences that fall on a surviving spouse when filing status shifts from married filing jointly to single. It is not a penalty in the sense of a punishment or a mistake anyone made. It is built directly into how the tax code treats single filers versus married filers. And it hits people who did everything right, saved carefully, planned responsibly, and simply did not know this particular piece of the puzzle existed. Understanding it is the first step. Planning for it, while there is still time, is the second. We are going to walk through both by staying with Carol and letting her story show us where each consequence comes from. The first revelation, the standard deduction cliff. When Carol's accountant pulled up her new return, the first thing he showed her was the standard deduction. For the years she and Franklin filed jointly, both of them over 65, their standard deduction had been approximately $35,000. That amount is subtracted from gross income before any tax is calculated. It is, in effect, a portion of your income that the government does not tax at all. As a single filer over 65, Carol's standard deduction dropped to approximately $18,000. In 2026, that difference is roughly $17,000. $17,000 of income that was once sheltered from federal tax and is now fully exposed to it. To understand what that means in real numbers, if Carol had $60,000 in gross income, she and Franklin might have paid federal tax on roughly $25,000 of it after their joint deduction. As a single filer, Carol pays federal tax on roughly $42,000 of the same $60,000. She is not earning more. She is simply being taxed on more of what she earns, because the standard deduction available to her was cut nearly in half the moment her filing status changed. This is the first wall Carol hit. It was not something her accountant could fix after the fact. It was simply the new reality of filing alone. The practical weight of this falls differently on different households. If your income in retirement comes mostly from Social Security and is modest, the impact may be limited. But for retirees with IRA distributions, pension income, investment income, or any combination of those things, income sources that do not disappear when a spouse dies, the standard deduction cliff is where the penalty begins. The second revelation, the bracket compression. Carol's accountant moved to the next section of her return, and this is where things became more difficult to explain. While Carol and Franklin had filed jointly, their taxable income needed to exceed more than $100,000 before it was pushed into the 22% federal tax bracket. That meant a wide and forgiving range of income that was taxed at the lower 12% rate. As a single filer in 2026, Carol hits the 22% bracket at just over $50,000 of taxable income, roughly half the threshold that applied when she was filing jointly. Here is the critical point. Carol's income did not double, but the brackets that determine her tax rate were compressed to half their former width. This means that income she and Franklin once paid 12% on is now, for Carol filing alone, being taxed at 22%. The same dollars, a higher rate. Her accountant used a simple way of describing it. He told her to imagine a highway that once had 4 lanes and now has 2. The same number of cars, the same amount of income, but far less room to move at a lower speed. Everything gets squeezed into higher tax territory faster. For Carol, this compression cost her real money each year. And because her IRA distributions would continue, indeed required minimum distributions would eventually require her to take out even more as she aged, this was not a one-year problem. It was a permanent shift in how her retirement income would be taxed for the rest of her life. Stepping back, what Franklin's side of the story looked like. Now let us look at this situation from a different angle, because Carol and Franklin's story did not begin with his death. It began years earlier, with decisions the couple made that they did not realize would shape Carol's tax picture after he was gone. Franklin had a traditional IRA, money saved over decades of work, never taxed, waiting to be withdrawn in retirement. When he retired at 67, he and Carol started drawing modest amounts from it each year to supplement their Social Security income. They stayed comfortably in the 12% bracket. Their combined Social Security income was healthy. Life was manageable. What Franklin and Carol did not do, what their accountant now wishes they had discussed, was use the years when both of them were alive and filing jointly to convert some of that traditional IRA money to a Roth IRA. A Roth conversion means paying taxes on the converted amount in the year of the conversion. But it also means that money, once converted, grows tax-free and is not subject to required minimum distributions during the original owner's lifetime. During the joint filing years, Carol and Franklin had room in their 12% bracket, room they never fully used. A qualified financial advisor, had they discussed this strategy, might have suggested that they convert a portion of the traditional IRA to a Roth each year, using that unused bracket space to pay a modest tax bill now and avoid a much larger one later. They did not know to ask. And now, Carol faces the full weight of that traditional IRA alone, required to take distributions each year, taxed at rates that are harder on a single filer than they would ever have been on a married couple filing jointly. This is one of the central lessons in Carol's story, and it applies to every married retired couple watching this right now. The years when both spouses are alive and filing jointly may be the lowest tax years your household will ever see. What you do, or do not do, with that window has consequences that extend well beyond your own lifetime. The third revelation, the Medicare premium surprise. About 18 months after Franklin's death, Carol received a notice about her Medicare Part B premium for the following year. The number was higher than she expected. Her accountant explained why. Medicare uses something called IRMAA, the Income-Related Monthly Adjustment Amount, to determine whether higher income beneficiaries pay a surcharge on top of the standard Part B and Part D premium. The income thresholds that trigger those surcharges are different for married couples and single filers. In 2026, a married couple does not face IRMAA surcharges until their combined income reaches approximately $218,000. A single filer, by contrast, begins facing surcharges at approximately $109,000, exactly half. Carol's income, between her Social Security survivor benefit, her IRA distributions, and some investment income, was above that single filer threshold. While she and Franklin had filed jointly, their combined income had never triggered an IRMAA surcharge. As a single filer, with income that had actually declined from the household total, Carol now exceeded the threshold that applied to her alone. Her Medicare premiums went up. Her income went down. This is the widow's penalty appearing in a second form, the same financial pressure expressed through a different system. There was one piece of information Carol's accountant gave her here that made a real difference, and it is worth knowing. A spouse's death qualifies as what the Social Security Administration calls a life-changing event. A surviving spouse can submit Form SSA 44 to request that Medicare reconsider the premium surcharge based on current income rather than the income shown on a tax return from 2 years prior. which, for a new widow or widower, may reflect the higher combined income from when both spouses were alive. If you or someone you know has recently lost a spouse and is seeing unexpectedly high Medicare premiums, this form is worth discussing with a qualified tax or benefits professional. The fourth revelation, the Social Security reduction. There is one more layer to Carol's story, and it is one that began with a decision she and Franklin made years before he died, a decision that felt entirely reasonable at the time. Franklin claimed his Social Security retirement benefit at 62. He had worked in a physically demanding job, his health was not perfect, and they needed the income. The monthly check was reduced because he claimed early, before his full retirement age, but they made it work. When Franklin died, Carol became eligible for a Social Security survivor benefit. The monthly amount the Social Security Administration would pay her based on her husband's earnings record. But the survivor benefit a widow or widower receives is based on what the deceased spouse was actually receiving, or what they would have received at their full retirement age, depending on when they claimed. Because Franklin had claimed early, his benefit had been permanently reduced. That permanent reduction carried over to Carol's survivor benefit. The amount she inherited as his survivor was smaller than it would have been if Franklin had claimed at full retirement age or later. There is no way to undo this after a spouse has died. The claiming decision that felt small and practical years earlier, claiming at 62 rather than waiting, became a permanent feature of Carol's retirement income. And she would live with that reduced benefit and the taxes calculated against her as a single filer for however many years remained. This is not said to make anyone feel guilty about decisions already made. It is said because for married couples where both spouses are still living, where the higher earner has not yet claimed Social Security, or where there is any flexibility remaining, the survivor benefit implications of that decision deserve serious attention. The higher the benefit the surviving spouse inherits, the better protected they are after the loss. What Carol did next. Carol's story does not end in the accountant's office with a larger tax bill and a sense of loss about decisions that could not be undone. Because while some of the widow's penalty was now fixed in her situation, not all of it was. Her accountant worked with her on the RMD situation. Because her traditional IRA was large, her required minimum distributions would grow each year as she aged. That growth would continue to push her income higher, further into the compressed single-filer brackets, and further above the IRMAA threshold. They discussed a strategy of managing the size of those distributions carefully, taking no more than required in years when income was already elevated, and looking at whether a qualified charitable distribution might reduce her adjusted gross income if she was charitably inclined. A qualified charitable distribution, sometimes called a QCD, allows IRA owners who are 70 and a half or older to direct a distribution, up to a significant annual limit, directly to a qualifying charity. That amount satisfies the required minimum distribution for the year, but is not counted as taxable income on the return. It does not solve the problem entirely, but it can reduce the taxable amount. She also learned, for the first time, about the qualifying surviving spouse filing status. This is a provision in the tax code that allows a surviving spouse without a dependent child to use the married filing jointly tax rates, the wider brackets and higher standard deduction, for the tax year in which the spouse died and potentially for a limited window beyond that, subject to IRS requirements. Carol had used this correctly in the year of Franklin's death. What she had not known was the full landscape of what followed after that window closed. Her accountant told her the most honest thing he could. Some of what she was now experiencing could have been softened meaningfully with planning that happened 5 or 10 years earlier. But she was not without options, and she was not alone in this situation. For married retirees who are watching this together, and especially for the spouse who handles the finances, here is what to do with Carol's story. Step 1. Understand that the joint filing years are a planning window, not just a filing status. While both spouses are alive and filing jointly, your household has access to wider tax brackets and a larger standard deduction than a surviving spouse will ever see again. Use that window deliberately. Work with a qualified tax advisor or financial planner to understand how much room you have in lower brackets and what moves, including Roth conversions, might reduce the tax burden on the surviving spouse in the future. Step 2. Review your traditional IRA balances honestly. Large balances in pre-tax retirement accounts, traditional IRAs, rollover IRAs, 401ks, represent future taxable income. Every dollar in those accounts will eventually be distributed and taxed. A surviving spouse inheriting or continuing to draw from those accounts as a single filer will pay those taxes under compressed brackets. Discuss with a professional whether it makes sense, while both spouses are alive, to convert a portion of those balances to a Roth IRA using the joint filing advantage. Step 3. Think carefully about the higher earner's Social Security claiming decision. If the higher earner in your household has not yet claimed Social Security, the claiming age affects not only your own monthly benefit, but the survivor benefit the other spouse may receive for the rest of their life. Delaying the higher earner's benefit to full retirement age, or even to 70, can significantly increase what the surviving spouse inherits. This is one of the most powerful and permanent levers available to a married couple, and it deserves specific conversation with a Social Security or financial professional before any claiming decision is made. Step 4. Know about Form SSA-44. If you are already a surviving spouse and your Medicare premiums have increased based on income from the years when your spouse was still alive, ask a qualified professional about submitting Form SSA-44. A spouse's death is a recognized life-changing event that may allow the Social Security Administration to reassess your IRMAA surcharge based on your current income rather than older joint filing income. This is frequently overlooked and can reduce Medicare costs in the first year or two after a loss. Step 5. Look into qualified charitable distributions if you are charitably inclined. If you are 70 and a half or older and take required minimum distributions from an IRA, ask your tax professional about QCDs. Directing a portion of your distribution directly to a qualifying charity can reduce your adjusted gross income, which affects both your tax bracket and your IRMAA calculation. This is not a strategy for everyone, but for surviving spouses facing growing RMDs, it is worth understanding. Step 6. Do not try to manage this alone. The tax situation after losing a spouse is one of the most complex and consequential financial transitions in retirement. The grief is real, the decisions are real, and the mistakes made in the first year after a loss can be costly. If you do not have a tax advisor or financial planner who has specifically walked through the widow's penalty with you, this is the right time to find one. Ask them directly, what does our tax situation look like if one of us dies? What changes? What can we do now while both of us are alive? That conversation, however uncomfortable it feels, is one of the most protective things a married retired couple can do for each other. Carol's story is not a story about someone who made mistakes. It is a story about something that was never explained. She and Franklin did everything the conventional wisdom said to do. They saved. They claimed Social Security when it made sense for their situation. They filed their taxes every year. They lived carefully. What no one told them, and what this video is here to tell you, is that the tax code treats a surviving spouse very differently from a married couple. The standard deduction nearly halves. The tax brackets compress. Medicare surcharge thresholds tighten. Required minimum distributions continue, and they are taxed harder under single-filer rules. Social Security income, if the higher earner claimed early, may be permanently reduced for the widow or widower who outlives them. None of this is a punishment. It is the architecture of how the tax code works. And the best time to plan around it is before it happens, while both spouses are alive, filing jointly, and still have the flexibility to make decisions that will protect the one who survives. If you are in that window right now, use it. Talk to someone qualified. Ask the question Carol wishes she and Franklin had asked 10 years earlier. What happens to the one of us who is left? The answer to that question, planned for in advance, can mean tens of thousands of dollars of difference over a surviving spouse's remaining years. If Carol's story sounds familiar, if you recognized your own situation somewhere in it, leave a comment below with the word widow or widower so we know this topic matters to you. Share this video with your spouse, your adult children, or anyone you know who is navigating retirement finances as a couple. These are conversations that are easier to have before a loss than after one. If you want us to go deeper on any part of this topic, Roth conversion strategies for retirees, how required minimum distributions are calculated, the full picture of Social Security survivor benefits, or how to read an IRMAA notice, tell us in the comments. We read them all. And before you make any changes to your retirement accounts, filing strategy, or Social Security plan based on this video, please review your specific situation with a qualified tax professional or financial advisor licensed in your state. Rules vary, situations vary, and the right approach for your household depends on details that only someone reviewing your full picture can properly advise on.